August sales are down. Well, you know what? Every August sales are down. Yeah, all this and more with a good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, back with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
I am great, Gary. How's things with you?
Things are excellent. We're into the last couple of weeks of August, which if you are living in Canada, watching in Canada, that's kind of our summer, tying it all up as kids get ready to go back to school. And I don't know about you, the last couple of weeks of August is just like a big chill before September starts.
Yeah, and in fact, I'll tell you, in terms of, say, some of our mortgage clients who were all sort of set to go in June and July, come August, they all disappeared. Meaning, we started applications, but I can appreciate that everybody's on holiday. So a lot of these people who started applications have said, look, Dion, we'll pick this up in September when the kids are back at school. So I totally get that. I feel like a lot of people go into that sort of mental mode over this season.
Yeah. It's funny. We often forget about what it does to the market when people go on vacations and things like that. People still have homes for sale. See, people are still buying and selling. It's just not that's not high on that priority list, we might say, right?
Yeah, and I think you've got some stats that show that exactly. So why don't we take a look at that?
We should. I'm going to share my screen, and this is in lieu of. This is in what's the word I'm looking for? To follow up with our conversation of our most recent video where we went through an RBC report, and the headline of the report was RBC says prices are still going to continue to drop, and yeah, that was not really a lot of breaking news. What I'm going to show you though is a chart here, and I'm going to walk us through this chart, Dion. These are the average days on market. So if you're a seller and you're thinking to yourself, wow, my home is sitting on market here, I want to just remind everybody of just the cyclical timeline of selling your house throughout the year. And what we're looking at here is data going all the way back to 2014, and any peak, any rise here is basically the start of a new year and how many the average days on market. And you can see every time we look at a peak, it's the start of a new year. And that other peak right here, Dion, the secondary peak, if you will, guess what? As you can see here, is August. Mm-hmm. It takes longer for your home to sell in those in the late August and December, January. And of course, as we just discussed, people are going on vacation. Buying a home might be third or fourth or fifth on that priority list. And I'm curious, is that similar to like the refinancing world and mortgage inquiries and the like?
Yeah, so we've noticed a slowdown in activity, and also maybe deals that are closing that was, they're refinances that could have closed in August or September, sometimes getting pushed a little bit later, right? To say October or whatever, just because people aren't focusing mentally on this stuff. They're dealing with their kids and holidays and vacations and all those summer camps and all that stuff right now.
Yeah, exactly. And you pointed out something kind of interesting too. So the last three spikes here are post-COVID years, and you said, well, look at that. They are going on averaging up over the last couple of years. And if you look at it, if you kind of follow that to January 25th, which is 46 days on market on average, it's kind of in line with what we're seeing in the 2014, 2015 timeline. Yeah. And a lot of people will remember our early COVID years where things were selling like hotcakes. And then 2018, 2019, things were still selling like hotcakes. And we forget the big picture.
Yeah. Because people just remember how fast things sold for in 2020, 2021. And that's where that drop, that big valley is in the sort of in the middle of the chart there. Basically, you list your house today, it sells tomorrow, very, very few days on market. But yeah, when you look at pre-COVID and post-COVID, where, yes, we are a little higher than pre-COVID right now by the looks of it, but we're not too far off.
Not too far off. And I should clarify, this is for the entire Toronto Real Estate Board. And this would be somewhat similar, I think, if you looked at a lot of the different boards right across Canada. Maybe not the number of days on market, but that you could almost imprint this, we'll call it the timeline, and put it anywhere else in Canada. And the numbers might change ever, but the shape of the timeline, we'll call it, is probably very similar, very, very similar.
Yeah.
So, my friends, this when we have these conversations, Dion, and I know you do too, this just helps set the expectations for our sellers as well as our buyers, right? It's important to have that understanding of what's going on in the market and having that clarity around it.
Yeah, and that's where I think you need to really trust your realtor, who is going to guide you as it comes to the seasonality of stuff like this. I know some clients of mine who are ready to sell but have been waiting to list until September, when the market generally turns in the positive.
Yeah. I know I've got a client that's waiting for that second or third week of September. And you might say, well, Gary, if you've got a client, and Dean, you've got a client, I'm sure the next realtor and mortgage broker have a client as well. We will see an influx of new listings come September, October.
Yeah.
And it shouldn't come as a surprise because of what we see in the market here and the cyclical that as that real estate cycle works. That's something that we always see. We might see a little more than usual. However, it should not come as a surprise. Okay, my friend, let's get into some of the cool things that you've been having conversations with your clients. And one of the things that you and I both passionately get behind, even in markets just such as this. And we've been very fortunate to own our real estate investments for 10, 12, even 15 to 20 years. There are still opportunities in there, and there are still conversations being had on, educating our clients on the value of real estate. I know you had that opportunity this past week.
Yeah. So one of my clients, it surprises my clients sometimes to find out that our clients include people such as bank managers and financial advisors who work for the bank where they keep their money at, right? And there's a couple of reasons why other financial professionals will choose to use a mortgage broker. And oftentimes it's because they're more informed than the regular consumer, because they know that we'll likely get them a better rate because we have access to more lenders, or that borrower who happens to work at the bank is in a unique situation where they may be buying their, seventh property, and their bank can't support them in that regard. But this week I was speaking with a financial advisor who works at a major bank. He makes around $400,000 a year in income. He's doing very, very well, and he's a little bit older, and now later in life, he's really discovered the power of real estate investing and the power of, in particular, leverage in the real estate market, which is not available in the standard traditional financial planning market when it comes to, say, standardized mutual funds that he sells to his clients. And so, long story short, if a client walks into a bank and wants to invest $100,000 with a financial advisor and, say, mutual funds, for the most part, that's all they'll get. They'll get $100,000 worth of mutual funds. But if that same client on the same day said, what if instead of investing in mutual funds, I wanted to buy a piece of real estate, how much money will you potentially lend me secured against, the fact that I've got $100,000 down? Well, that bank is going to give you $400,000 in addition to your 100, right? So that's a 80% loan. And so the power of leverage here is, you can invest $100,000 in mutual funds, or you can invest $500,000 in a piece of real estate. And it's not rocket science here, in that a small increase in the value of property, let's just say a property increases by 5%, that's $25,000 on this piece of real estate. Well, that $25,000 represents a 25% return on the $100,000 down payment that client put into that deal. And so, again, Gary, you and I know this. We've lived this. We've had some success with this over the years. But it's still interesting that even people in the world of finance discover when they discover real estate, the leverage, the power of the return on investment in real estate. they kind of turn their back on the other traditional investments. And so this particular financial advisor who works at a big Canadian bank is now very much set on acquiring some real estate.
Yeah, it's we all know if it was easy and that sort of thing, everybody would be doing it, and everyone has some sort of reasons why they are or why they aren't. And sometimes why they aren't, and just as simple as why am I not investing in this type of stock or that type of stock? Sometimes it's just knowledge and knowing and learning. It's not the fact that you have strong reservations against it. The fact is sometimes it's just simply knowledge and acquiring that knowledge.
Yeah, and I remember I was trained in to be a financial advisor as well. At the same time, I was studying real estate, and once I fully understood real estate, that's when I went all in on real estate, and that's where I built my career, and you have too.
Yeah, exactly. We all know that there are some unique monthly, sometimes yearly costs and that sort of thing to owning real estate, and of course, mortgage being the number one cost, which is quite clear. But some of the secondary costs, and we might think to ourselves, "Hang on a second, hang on. Why am I going to be investing, $10,000-$20,000 into this, property management or what have you, and I could do it myself?" Talk to us a little bit about that and just the power of, maybe another way to look at that.
Yeah, so a big reservation for people that stops them from buying real estate is the fact that there is involvement with a tenant, right? And management of the tenant and management of the property and maintenance of the property. And I totally get that. And what I want to say to everybody listening is if I had to deal with that stuff, I also probably would not be a property investor. Okay, so then the next question is, Dion, well, how do you deal with that stuff if you're not dealing with the tenant and you're not dealing directly with the maintenance and things? And the answer is you employ a professional property manager. Okay, so when people hear that, they'll say, well, isn't there a cost with that? And, is it worth it? And all of that. And I'll tell you what my client, who's the financial advisor, just told me this week. And he said, Dion, our clients that in the mutual funds and those types of things, they're paying usually around 2% a year on management of those funds. Okay. So if he's managing, for simple numbers, if he's managing $500,000, the fee on that at 2% is $10,000 a year. And people are happy to pay it. Okay. Now, when it relates to real estate, let's just say now we're managing a $500,000 piece of real estate. The management fee, the property management fee, is not calculated based on the value of the asset. It is based on the rent collected. Okay, so let's do some quick math here. The rent collected on, let's say, a downtown condo, smaller property, say $2,500 a month, $30,000 a year. Okay, now what would the potential property management cost be on something like that? In my experience, it's anywhere from 6 to 10%. So let's call it 8, right down the middle. 8%, it's $2,400 a year. So $2,400 a year for somebody to manage a $500,000 asset versus in the mutual funds, it's 10 grand a year to manage that same $500,000 worth of asset. So it's actually, now that I do the math, it's 4 times cheaper, 75% cheaper to pay a property manager to manage that property than a financial advisor to manage the equivalent asset value in mutual funds.
I like it. And we often think to ourselves, well, I don't want to get that phone call in the middle of the night for this or that. And in my experience, maybe a leaky toilet or this tenant can't do this or can't do that. Those phone calls are actually not as common as we think they are. Yet, when they do come, they are an incredibly frustrating and annoying. And sometimes when you're not a professional, you don't know how to handle them, give it to the professional, my friends. Hire that property manager. It will be a weight off your shoulders 10 times over. Wouldn't you agree?
Yeah, most definitely. And I think also providing a buffer between you and the tenant, where you don't ever really need to meet your tenant. It makes it more of a business transaction, a little bit more professional and a lot less emotional, which I think people get tied up with when it comes to real estate and real estate investing. And so, like with anything, when you're investing, you need to put on your business hat and take away the emotion where you can.
That's just it. That's just it. Okay, moving on. Over the last few videos, we've circled back to reverse mortgages, and now we're seeing some questions and some unique circumstances coming just as you experience whether that is the right product or the wrong product. Help us get some clarity around that with some of the conversations you've just had this past week.
Yeah. So in the last week, I've had 2 calls regarding specifically reverse mortgages. And the first one, gentleman named Tony, called me, older gentleman, above age 60, and he had about 35 grand worth of credit card debt. And he said, Dion, I've heard about reverse mortgages. I think maybe I need one. Now, when I looked at his situation, what became clear is that Tony did have debt, but he did have good cash flow. And once we looked at what he needed, he actually didn't need a reverse mortgage. All he needed was a home equity line of credit, which he was able to qualify for because even in retirement, he had good retirement income, and the monthly payment associated with his mortgage and consolidated debt was still very manageable. So for Tony, even though he called me for a reverse mortgage, we actually put him into a line of credit, which for him was the right choice. Okay. On the flip side, I had a different call from a lady this week named Linda. Now, Linda, again, a little bit over the age of 60, she actually called me for a line of credit. The reason she wanted a line of credit was so that she could finish her basement apartment so that she could get extra rental income. Okay. So when we talk things through with her, what became clear is that her income in retirement is a lot less than, say, Tony's was. Okay. And so when I ran the numbers, what I realized is I could get Linda this line of credit, but in terms of cash flow, it's not going to put her in a position where she would actually be comfortable over the next decade or so. And so that actually led to a conversation about a reverse mortgage, which she hadn't considered. And once she understood what it was and how it would specifically help her with her needs over the next 10 to 20 years, for her, it was a no-brainer. Yes, that was the product for her. So I point this out to say sometimes people have a general idea of what they think they need, but it's only upon further, deeper investigation of their personal circumstance that, the product they thought they needed is not the one they need. And there is a better product that suits their particular circumstance. So for anybody sort of in that situation, debt consolidation, older, wondering if the reverse mortgage or just a regular mortgage is right for you, we have those conversations every day, and we'll guide you to what we think might be the better choice for you.
Yeah, and that I love it. It circles back to our early conversation about sometimes you just don't know what you don't know, and then the knowledge and having that conversation with you and your team. That's excellent. Okay, I know this. The answer is obvious. However, it sometimes needs to be addressed. Dion, do I need to not only file, but pay my yearly taxes in order to get qualified for a mortgage?
Okay. So the answer there is it actually depends. Okay.
Oh, okay.
So, yes. So sometimes people contact us and they say, Dion, I'd like to buy a property, but I haven't filed my taxes for the last year. Okay. Now, my next question is this. Are you an employee or are you self-employed? Okay. Because if you're an employee, the fact that you haven't filed your taxes, in most cases, it doesn't actually matter. Because if you're an employee, what banks are looking for are your pay stubs and your T4s. They're not looking for whether or not you've actually filed your T1 general. They're not looking for whether you have received a notice of assessment back from the CRA. Okay. So a lot of people, sometimes they think they need more documentation than they actually need. Okay. And to that same end, some people think that they have to have worked for at least 2 full years before they can qualify for a mortgage. The answer there is no, they don't. They only have to have passed their probationary period. So if you just graduated and you're now 3 months into your job and you just passed probation, well, guess what? Most banks will be totally fine with your income at that point. So you don't have to wait 2 years. Okay. Now, If you are self-employed and you haven't filed your taxes, that could be an issue, because the only way that, in particular, major banks can assess what your income is if you've actually gone to the CRA and said, I grossed this much money, but I expensed this much, and here's actually how much I really, really made. Okay. And that final number is only visible on your notice of assessment. And therefore, that's what the banks want to see. The T1 General and the notice of assessment is what banks are going to want to see for self-employed people. So, short story, if you're an employee, there's less documentation, no need to file. If you're self-employed, you definitely need to have filed. If you're trying to get approved with a major bank, and if you haven't filed and you really need a mortgage and you're self-employed, we can still help you with alternative lenders who don't care about those tax returns.
There you have it, my friends. All good stuff as always, Mr. Dion. Remind us how people can get a hold of you.
Yeah, at kangamortgage.ca or on Instagram at @Dion
There you have it, my friends. That's Dion Beg. Of course, I'm Gary McGowan, and we'll see everybody in the next episode. Goodbye for now.